every market that you trade will constantly shift from balance to imbalance, with consolidation ranges, to directional movement looking for higher or lower price points. The most relevant and new information we have about the possible acceptance of price is by comparing the open and the market's reaction to yesterday's price range. And while today may be a new day, you should take a moment to look back at yesterday to see how your instrument did. When you think of price range, many traders will think of the average true range indicator. And while the ATR is useful for the purpose of comparing the open for today with the range of yesterday, we want to resort to looking at the actual price. The range of price is a measurement of the high and low, and while we can see all aspects of the daily candlestick on the left here, we don't know what came first. It is possible that the market opened, sold off, pushed to new highs, and then closed off the highs as shown on the right. Another way that price could have evolved throughout the day is the market opened, pushed to new highs, market sold off to form the daily low, and sometime throughout the session, price rallied to close just off the highs. How price evolved to form the daily candlestick or bar may be important to traders depending on their trading strategy. And depending on which methods you use to analyze the markets, the answer to this may vary on what is price acceptance. Well, broadly speaking, it is persistent trading of a market at the same price as was previously traded. So if a market spends a reasonable amount of time at these prices without encountering any major activity to move it to new prices, this can be considered acceptance to some degree. Now, this doesn't mean that the price won't deviate from accepted areas, just that the trading activity is more likely to be balanced than imbalanced, which means the range of price will be lower. The three different positions indicated here highlight whether on market opening, the perception of value has changed. If market opens near the middle of previous day's range, it's likely that there is a little difference, at least initially, and unless information comes out which creates an imbalance, trading can overall be expected to be somewhat balanced throughout the same range. Opens above or below the previous day's range near the extremes. The immediate possibility is that something may have already changed, and the key is to look for acceptance or rejection of the new prices. If the market opens outside of the prior day's range, does it spend time trading there, or is price quickly moved back into the known area of the prior day? Acceptance gives rise to a further move in the direction of the change, and it could itself be that. Rejection and a move back into the prior day's range, followed by acceptance of that range, could give rise to a further move into the same range. After all, if the balance is intact, then prices on the extreme will be viewed as expensive or cheap depending on which end the price sits. If the market opens up below, maybe a counter trend trading strategy would come in handy. So why does that matter to you and your strategy? Comparing the open to yesterday's range can give us an early indication of whether anything has changed, and so what the directional bias may or may not be. So with this knowledge in hand, setups of any kind occurring in the same direction stand a greater chance of achieving a successful outcome.